that everybody enjoyed. And Zach, let me bring up something. There is so much talk about what's going on with the tax plan. When is it going to go into place? Is it going to be retroactive? Is it going to pass? The big talk out there is how it's going to affect corporations. And the talk as well, lower taxes, companies bring more money over to us here in the United States, and hopefully that will create more jobs, more hiring. But I think, Zach, a lot of people are scratching their heads about how is it affecting them? Do they fully understand it? Maybe there are different tax levels or a less amount of tax levels, but the question is, people are hearing that certain deductions may go away, certain areas may be increased, maybe the percentage of tax will lessen, but maybe the deductions they were able to take, they won't be able to take. I think a lot of people are confused, Zach, and I think it's so important to break it down to you and I, to the listeners, to give people a good idea of what they can expect. And Zach, as I'm saying this, I'm thinking to myself, why weren't we smart enough to have a CPA call in, have an expert call in? Zach,
we really should have planned this out, Dave.
Zach, you know what? We get so
doing.
busy in the morning. We came in this morning, all the people out front clapped. We might as well just take calls today. I don't know what to talk about. Good morning. It is the lighter side of finance.
David Cross, and it's Chris Whalen, CPA. I had the feeling that you needed to talk to me this morning.
My goodness. Zach, this doesn't seem rehearsed at all. What are the odds of Chris calling us today?
Good morning, Chris.
Chris, so
morning,
timely.
Zach.
My goodness, how have you been?
Everything's been fantastic, especially with this new tax plan that's going. I've been very busy, as you can imagine.
You know what? I'm so glad that you called because a lot of people are here. They watch their favorite financial show or maybe their favorite financial radio show. And I think a lot of people don't get how it impacts them. They're hearing different things and how it may affect corporations and the good that that may do for corporations, bringing money back, hiring more people, helping the economy. But let's be honest, you and I aren't corporations. We are individuals. Our listeners out there are individuals. Yes, there are definitely some business owners out there, but I think the concern is how is it affecting the individuals, different ideas that are going on. And if you don't mind, let's talk about different things that maybe you're suggesting that people are listening right now should talk to their CPA about prior to the end of the year, going in before 2018.
Definitely. Well, the first thing to remember is that the plan is not retroactive to the beginning of this year of 2017. So any tax planning you had, or if you felt you had a tax situation you're in right now, that is not changing, and it's really going to be effective probably next year, January 2018. So the most important time really to plan, especially after your taxes are done for 2017, that's when you really need to have a sharp person helping you to see how does your situation fit in to all the new laws that are being passed for 2018.
So you're suggesting that before the end of the year, maybe it's a good time to sit down with the CPA or your accountant because it isn't going to be retroactive. They're not going to go back and say, okay, our changes for this tax plan are going to affect 2017. It's going to be 2018 on, if I'm hearing you correctly.
Exactly. So everyone's been hearing about there's certain itemized deductions that might be eliminated as a deduction or limited even further. So, for example, let's talk about a few of those. They're
Please.
talking about eliminating the state income tax deduction as an itemized deduction. That's pretty much common between the House and the Senate bills that they're trying to hash out right now. So one strategy right now is for people who are paying estimated taxes to New Jersey. The fourth quarter estimate for 2017 would be due January 15th, 2018. Now, as a tax basis cash payer, you can't take that deduction if you don't pay it in 2017. So I'm urging everyone who might have an estimated tax payment due to pay it this year. So we definitely get the deduction on your Schedule A this year because it's still deductible in 2017.
That's a great point. So in other words, for people that are used to paying their fourth quarter estimated tax come January, because of these possible changes, you're suggesting take care of it in 2017 before the end of the year.
Exactly.
What about real estate taxes? There's a lot of talk about the deductibility there. Any suggestions or different things that you're seeing that could impact our listeners?
Well, I'm saying that the same thing for real estate taxes because they are talking about eliminating that deduction fully, the property tax deduction, but they are talking about limiting it somewhat. We don't know the exact number yet. So in order to make sure that we do get a full deduction for what we're paying, we also can prepay real estate taxes in this year for 2018. And being cash basis, we can deduct them this year.
So what I've been hearing is, and correct me if I'm wrong, Chris, that there's a possibility of it being eliminated, or maybe there's a certain write-off up to a certain level. I'll just start at, say, 10,000 or something like that. It's just the unknown that there may be the opportunity to write some of it off for next year, or maybe not at all.
Exactly. So why not pay something now so we know we're going to get a full deduction because the law is not changing for 2017. Right here, I'm looking to maximize the impact of old law and what we still can take as an itemized deduction in 2017. I'm trying to save every possible dollar for my clients right now.
Chris, excellent question for you now. We have a lot of individuals that are taking the required minimum distributions. And in fact, last week we talked about a couple different strategies and ideas where people can take their required minimum distribution, either say fund life insurance or maybe take an in-kind distribution of an investment they have. One item that we've talked about in the past, Chris, is charitable contributions. For example, if people are looking to take a charitable contribution now from whatever source of money, even if it's, like I said, the required minimum distribution, utilizing in that direction, are you suggesting maybe people not only do the contribution they normally would for this year, but maybe to do maybe what they would consider for next year just because of the uncertainty?
100%. There are people who give annually to certain charities this time of year, and they possibly could eliminate or limit charitable deductions next year, just as we talked about the other areas. Why not front load that to charity for 2018 into 2017, especially using an RMD is a great idea to do that with.
That's a great point, Chris. And the reason why I wanted to bring that up is in a lot of cases, depending on how much an individual is going to contribute to a charity, if they're taking the distribution from their IRA, the required minimum distribution, that can act as a deduction on the amount of that income that would actually be for that given year. Again, I know there's certain limitations, but for people that just don't need the required minimum distribution, they're simply just taking it for 2017, that may be a nice deduction for them that next year may not look as attractive. Is that the best way to look at it?
Yes, and you want to make the transfer directly from an IRA to the charity. And there's your investment, your broker will have forms for that, and the charity will have forms for that. So the money should go directly to the charity from your IRA.
See, that's great that you bring that up, Chris, because a lot of people, I don't think they're aware that they can do that. So there are ways in which instead of getting the money, say, into their checking account or getting a check, there's an opportunity to actually send it right to the charity. I appreciate you bringing that up. A lot of people aren't even aware of that. The benefit of this is that if it goes directly, they don't even need to itemize their deductions. They get a charitable deduction. It's tax-free. So that's why it's important to do it directly. And you never take the money and then send it. So it's a very, very, very good tax strategy, especially for people, whether you itemize or not. So in 2018, and that might go away. So for everybody that could do this, whether you itemize or not, it's a great tax-saving strategy. Now, for individuals, let's say that have already done the required minimum distribution, this would be something where they would, and let's say they did take it directly to themselves, put it in their checking account, whatever they have done with it. This would be something where they should talk to their CPA as a possible write-off for what they took as a distribution. But what you're saying here, Chris, if I'm hearing you right, is maybe this is an opportunity before the end of the year to do a little bit more, do what you're possibly thinking of doing in 2017 or 2018, excuse me.
Exactly.
Can we talk about medical deductions? Again, other concerns out there of what that's going to look like next year, and possibly talk about some different deductions that people may not be aware of that they could utilize in 2017, but may be limited in 2018.
Sure. Well, first, there is talk of eliminating medical deduction on a federal level, but I want residents of New Jersey to know that there is still a very, very good medical deduction in New Jersey And the floor for that, meaning how much income you need to earn before you get deduction, is very low. So regardless of what happens for federal, everyone should still be accumulating their medical expenses in 2018 because you'll still get a very, very good deduction in New Jersey. So, for example, I deal with this a lot as we've talked about this on prior shows, that there's a lot of things that people could take as a medical deduction they don't realize, especially with a doctor's note. I always think of what are expensive things we need to buy for ourselves. Well, a mattress, for example, is something that if you get a doctor's note for that, that's a medical deduction, and that's a significant expense for people. Number one, let's say you belong to a gym under doctor's orders. Well, why not prepay your 2018 membership for a gym in December right now and take it as a deduction or attempt to? Don't forget, we can take home fitness equipment if we have a medical note from a doctor. So there's some really large expenses that we might be having in 2018 for our fitness or health that if we pay for them now, we can get a great tax deduction still in case the feds eliminate that deduction next year. Does that make sense?
Oh, that absolutely does. And I think a lot of people aren't aware of, say, the ability to write off a mattress like you're talking about or fitness equipment, that they should lean on their trusted CPA to see if that is something that they could write off. And I think if I heard you right, Chris, you're saying for something like that, it's advisable to get a doctor's note where the doctor is clearly stating that you need a certain type of mattress or you're going to need a certain type of fitness equipment just for your general health.
Now, hey, don't forget, you may need an air conditioner for the relief of allergies, right? Everyone should be thinking of these things. This is a very expensive item. What if you need an air conditioner for a respiratory problem?
Okay.
If the doctor, so that's several $1,000s. So these are all things to be thinking of right now that we could pay for by the end of the year. What if that deduction's lost next year, right?
I'm glad you clarified that, because what I just said before about different things that you may need, it's specific to a condition. Rather than general health, it's something that, like you said, something that you need. Say you have a bad back, it's the mattress, or something that you need for equipment for fitness that because of whatever your condition may be, it is required that you do a certain amount of working out, and either the health club membership would be an expense to take care of this year, for your 2018 expenses, or fitness equipment in the home.
Right. Everyone is spending a lot of time getting their teeth done, for example. So artificial teeth, which is a broad category, is something that you can deduct. What if caps or crowns, can be taken? And people always think of that as cosmetic, but you might need that for your health also, correct? So that's very expensive. And I find clients who don't realize that someone says, I had crowns put on that cost me $8,000. And they're thinking that they can't take that, but sometimes they can. So it's important to even, call me or call your tax preparer. I have memos and blogs just on this that give you a detailed list of things that you can take you might not think of. So do your homework now. We have a few weeks for the end of the year. You might be surprised that there are things you need to spend money on that you would have spent in 2018 and we could spend now and still get a deduction for.
Chris, can we talk about standard deductions? And for a married couple, I understand that number will double, but yet personal deductions, different write-offs may go away. Can you give us your thoughts on what that may look like, the good and the bad of it?
Well, right. This is something that the president's been touting as a great benefit, that he's increasing the standard deduction from $12,000 to $24,000 approximately. And so what that would do is there are certain people that don't itemize deductions now. So it gives them some deduction for their expenses. So that's what a standard deduction does. Now, what the president says, we're going to double that. That sounds fantastic. And that might mean some people might not need to itemize that as much. But there's something called a dependent exemption that we get for each taxpayer and each dependent. So that's about $4,000. So a married couple right now has a standard deduction of $12,000 if they don't itemize, and $8,000 worth of dependent exemptions. That's $20,000. So that, yes, the $24,000 might be a little higher, but it's not nearly doubling your exemption. So it still becomes extremely important to not think, I'm getting this $24,000 this standard deduction now, I don't need to worry about itemizing it. That's not true at all. It becomes even more important to really scrutinize what itemized we can take, especially in 2018. And again, please, everyone should know that everyone's worried, but we don't know exactly what the House and the Senate are going to agree to. And once that's done, I will be putting out memos and case studies on different scenarios, and also doing it for individuals who are concerned. How does this apply to them?
And Chris, absolutely, we will have you on when when we get to a point where we know exactly where we stand. And I can completely appreciate the fact that we're having this conversation and there are certain things that aren't definite. It looks as if we're going a certain direction, but right now it's just conversation. And speaking of that, Chris, can we talk about the possibility of the elimination of unreimbursed business deductions?
This is very, very important to a lot of people, because what an unreimbursed employee business expense is, this is something that someone who gets a W-2 could take if they are working for a company where they aren't fully reimbursed for expenses. Let's say you're traveling and they don't give you a mileage reimbursement. You have home office expenses. Those are very important for people to be able to take. Sometimes people have some very heavy unreimbursed expenses, and they're looking to eliminate that as a deduction, which would technically be a loss of wages for people if you think about it. Let's say that I'm a salesperson making $80,000 a year, and I could have a lot of mileage. I could have a $15,000 or $20,000 expenses that are unreimbursed. That really brings my taxable income down to $60,000, which is what I need. Under the new scenario, I have none of that to deduct, and my taxable income stays at $80,000. So this is also one of the reasons why I'm telling everyone. I've put out blog posts. That you need to call your senators, Congress people. I have lists on my website of all the contact information for all of our elected representatives. So this is something, if you know somebody that has unreimbursed business expenses, this is very significant to talk to them. And why is that? Because this has to change their relationship with their employer. That this has to be a negotiation now in 2018. I'm working with clients right now that I'm looking to negotiate a higher wage for them, because we have to offset the fact they're going to lose this, right? If I need someone now to make $95,000 a year, not $80,000, because they need to be made whole. They can't take a pay cut because of these tax changes, which is what would tell. And people need to think about this, because they don't understand. And you need to have someone proactive. You need to be proactive, and you need to talk to your boss and say, listen, the tax code's changing. My family cannot afford a $20,000 increase in taxable income.
Last piece, Chris, thank you for that. I just wanted to talk about this, and a lot of listeners, are aware that this is coming up, but it's possible that, this could change. But for 2017, for the estate tax, it's up to $2 million. For 2018, it's being eliminated. Am I right in saying that, as of right now?
Well, there are some people that want it eliminated totally, but they're also talking about increasing the cap to $10 million.
Okay.
Which would, the estate tax isn't paid by that many people, and it really is. This is used by the left a lot. That they say, oh, if you eliminate this tax, it gives the tax break to the rich. Well, the estate tax hurts middle class families a lot more. And let me briefly explain that. If I have a business, let's say I build a construction company and I've built it from the ground up, and I want to give that to my children. I want to pass it on to my sons and daughters. Now, the estate tax right now would sometimes forces me to sell that. I can't give it because it double taxes you. And the estate tax is not fair. Everyone should realize that the estate tax wants to tax assets that have already been taxed. So imagine you wanted to give your kids $100,000 when you died, and you already paid tax on that. And the government wants to take 50% of that before you give it to your children. I think you would be offended by that. So the estate tax is terrible for business, especially middle-class family businesses that sometimes can have a significant value. It hurts the transfer of wealth from a parent to a child. So I look forward to that being eliminated.
Zach, We need another half hour, maybe another hour. We have so
You
much
see
we
the
want to
band
cover.
coming.
But you know what? Before we go, Chris, please tell the listeners how they can get a hold of you, your website, and thank you so much for your thoughts and opinions on what's going on out there.
Sure. My website is chriswhalencpa.com, simply ChrisWhalencpa.com. There you'll find a contact page. Please write to me, text me, call me. My phone number directly is 732-673-0510. And again, reach out to me anytime. I'm available. My staff is ready to take care of any questions that you may have anytime.
And I think the big takeaway today, Chris, with everything that we talked about, your opinions, your thoughts of what could be, is that everybody listening, they can obviously reach out to you, or if they're dealing with their CPA or their accountant, to give them a call prior to the end of the year to see if there's certain things that maybe they need to take action on right now and not wait until 2018.
Right. Remember, the key moment is going to be when your 2017 taxes are done, is that's when you need to have someone evaluate how does your situation now fit into the new law and how does it impact you for estimated taxes and deductions. So that's the most important thing. And when your 2017 taxes are done this year, your work is just beginning, because we have significant changes that we need to see how they impact your family immediately after your taxes are done. I cannot wait.
Chris, thank you so much for being on today. There was a lot of useful information. And Zach, you got to lock the door. This band comes in at the wrong time.
They take over.
We got to give them a new tune or something. Thank you, everybody, for listening. My phone number, 732-657-3089. Please go to my website, www.davidcrossan.wfadv.com. Go on there, look at different articles and videos on investments and estate planning strategies. Have an amazing week, and let's talk next time. Take care.
The Lighter Side of Finance is a paid program. The views and opinions expressed in this program do not necessarily represent the views and opinions of the staff and management of this radio station or Town Square Media, LLC. The purpose of the program is to provide information only. Any financial transaction can only be recommended by a knowledgeable professional who is familiar with your financial situation. Wells Fargo Advisors, LLC is a registered broker-dealer and a separate non-bank affiliate of Wells Fargo and Company.